Okay, so the last two things to talk about this chapter, the adjusted trial balance. So we did a trial balance at the end of chapter 2 where we just pulled the balance in each account, and that's exactly what we're doing here. We're just doing it again. And so the trial balance that you do before the adjustments is called the unadjusted trial balance, and now after we've done our adjusting entries, we call it the adjusted trial balance. So it's the exact same thing. We just pull the balance in each account. Each balance is either a debit or a credit. The only new thing here is the accumulated depreciation. And as we said earlier, that is a contra asset, which means it's the opposite of an asset, but on the balance sheet it goes with, or on the trial balance it goes with the assets. So you'll actually have a separate accumulated depreciation account and a separate depreciation account for each asset that you are depreciating. So if you had, like, say, equipment, so you would list the asset, equipment, and then the accumulated depreciation, and then list the next asset, like say it's a truck, and then the accumulated depreciation for that one. So each one is tracked separately so that we can tell what the book value in that account is. So let's go ahead and do this. We'll have our account name here, and then it will either have a debit balance or a credit balance. And so we always start with assets, so we'll need cash, and in this one we don't know what cash is. We'll have to figure that out. We'll need land, that's an asset. We'll need the accumulated depreciation, that'll go with the assets. Equipment is an asset. Accounts receivable is an asset. Office supplies. Okay, I think that's it. So we'll put cash here, and we'll have to figure out what that is, but we know it'll be a debit balance because it's an asset. Accounts receivable pretty much always comes next, and that we said is 42.5, and it's an asset, so it has a debit balance. I put it on the debit side. Office supplies is an asset, and that's $900 debit. Let's do our equipment, which has a balance of $25,000 on the debit side. Then we'll put that accumulated depreciation for the equipment. That has a credit balance though, so that goes over here. And then our last asset is the land, which is $24,000. And so the next would come our liabilities. So we're looking for things with payable in the name: utilities payable, accounts payable, unearned revenue is a liability. I think that's all of them. So we'll put in, I always put accounts payable first. Liabilities have a credit balance, not pays. So that's $3,800 over here on the credit side. And then utilities payable, that's 55 or 550 over on the credit side. And then unearned revenue, which is 600 on the credit side. So assets, liabilities, next will come the capital and the withdrawals. So I've got Steve capital and Steve withdrawals. So Steve capital is 18,600. Capital has a credit balance. And again, feel free to go back to your chart from chapter 2 about what the normal balance in each account is. Then we'll have Steve withdrawals, which was here 28, and withdrawals has a debit balance. Then we'll have our revenue, which is here it is, service. Oops, I think I did. I crossed that off and I shouldn't have. Who did I give that to? Oh, I guess I'm good. Here's the withdrawals, 28,000. That will help, and the capital is 18,600. Okay, I think I'm just crossing the wrong things off. Then I've got service revenue. Revenue always has a credit balance, so that's 90,000 over here. And then I should just be left with expenses. So supplies expense, utilities, depreciation, salary. Yeah, so I've got supplies expense. Expenses all have debit balances, so that's 700. And then I've got utilities expense, which is 1550. depreciation expense for the equipment, 1,800, and then salary expense, 5,200. So the totals go underneath. I'm going to go back up to the top here because I'm going to run out of room in it. This thing actually funny when you get to the bottom. So if I add up, so pretend like this is at the bottom. So if I add up the total credits, I get, hold on, I write that down somewhere. If I add up the total credits, I get 115,050. If I add up the total debits, I get 91,400. So I know that my debits have to equal my credits. So if I subtract these two, the difference must be what's in cash. So I'm just going to kind of change that to red. So if I subtract the 115 or the 91,400 from the 115, the cash must be 23,650. And so if I added 23,650 to this, I would get 115,050, and my debits would equal my credits. So in reality, you're not going to have one like this that has a fill in the blank one. In reality, you would pull that balance, but at least it forces us to remember that the assets have to equal, the total debits have to equal the total credits. The next problem, and I'm just going to do a couple of these, I'm not going to do them all, is about what happens if we don't do these adjustments. And so they're saying, assume that this company failed to do these adjustments. What would the following situations be? So in each of these, there was something that didn't get recorded, an asset or a revenue, and there was something that didn't get updated, either a liability or an asset. So in the first one here, if I did not record, so this office supplies on hand, $100, I didn't record that adjusting entry. That means I didn't record the supplies expense that happened, supply expense, and I didn't update that asset of supplies. So if that's what happened, the assets are now overstated. I didn't bring that down, so it's still showing, I have $100 on hand, it's still showing whatever I originally purchased. So the assets are overstated. I didn't record this expense. So if expenses are understated, net income, if I didn't include all of the expenses, then the net income I reported is too high. And then what did I do with that net income? I gave it to the owner. So that means the net income that I gave the owner is too high, so the equity is overstated. And so everything, my balance sheet, my statement of owner's equity, my income statement are all wrong because I didn't do this adjustment. If we look at accrued revenues. So accrued revenues, what I didn't, that would have been a debit to accounts receivable and a credit to the revenue account, the revenue account. So if I didn't do that, then for B, I didn't record this. So my asset would be understated because I didn't add that into accounts receivable. My revenue would be understated. I didn't include all of the revenue when I did the income statement. So revenue is understated, which means the net income that I reported is now too low, right? I didn't include all the revenue in it. So if that means the net income that I gave the owner was too low, so owner's equity is understated. If we look at C, accrued interest expense. So the adjustment that I didn't do, I didn't record the interest expense, and I would have credited a liability, interest payable. So if I didn't do those, my liability is understated, right? I didn't do that, and the expense is understated. And if the expense is understated, that means the net income I gave the owner was too high, so that is the owner's equity is overstated. Well, I might as well finish them, right? Depreciation, if I didn't do that, I didn't record the expense that took place, and the asset, or really the contra asset, wasn't updated. So the value of that asset has gone down, but I didn't record that. So my assets are overstated. My expense, I didn't record that, so my expenses are under. If my expenses are under, the net income is too high, which means the owner's equity is overstated. I gave him too much. And then the last one, unearned revenue that has been earned. So that means I did not record this revenue that has been earned, and I did not decrease that liability. So the liability is overstated. It's saying I owe more than I really do. The revenue is understated, which means that net income that I reported is too low. It didn't include all the revenue. That's a little hard to read. Too low, which means I didn't give the owner enough, so that's understated as well. So the moral of the story here in this one is if I don't do these adjustments, all of the financial statements that I'm going to generate are going to be incorrect. So that's why these are so important. The last thing I want to show you here is the worksheet. And we're going to start the worksheet in this chapter. We're going to finish it in the next chapter. And the beautiful thing about the worksheet is it shows us this entire process on one sheet, because we're going to add to it a little bit here. And so the first two columns show us the unadjusted trial balance. That's the balance in each account after all my journal entries are done. That's what we did at the end of chapter 2. Then this one, the next two columns show me the adjustments that I did. And so for each adjustment that I did, I had one debit and one credit, and I'm just transferring those over here. So, well, let's start with this one. So, and you can see them labeled with an A. So here you can see I debited supplies expense, and so I'm guessing the offsetting credit is over here with supplies. So one debit, one credit. I debited supplies expense, I credited office supplies. Then for B, I debited depreciation expense right here, and I credited accumulated depreciation. One debit, one credit. So again, if you've already done these journal entries, you're just transferring them over here. Oops. And so you could see C here is one debit, depreciation expense, one credit, and A, B, C, D, I debited salaries expense, and I credited salaries payable here. Oops. And E, I debited accounts receivable, credited the service revenue, accounts receivable, credit service revenue. And then the last one here looks like I debited unearned revenue, the liability, and I credited the revenue account. So for each account, for each journal entry, I've got one debit, one credit. That's just what I did. Again, my total debits have to equal my total credits, just like they did over here. Then the last column, the adjusted trial balance, oops, I didn't mean that to be read. I'm just going to update each one with what the new balance is. So cash, I started with a debit balance. I didn't do anything to it, so it has the same balance. But accounts receivable, I had a debit balance of $5,000, and then I debited it another $1,300. So I added those two together to get the new balance of $6,300. For office supplies, I started with a debit balance of $1,000, but then I credited $800. And so I had a debit balance and I credited, so that means I subtracted, and here's my new balance of $200. And so I just keep doing that with all of these. If it's a credit to a credit, like for instance in this accumulated depreciation, I started with $4,000 credit. I credited another $2,000. So that's those two are the same, credit to credit. I add it together, and my new balance is $6,000. So here's one quick problem here where we're going to post these adjusting entries. So we've got 3 adjusting entries here. So for adjusting entry A, I like to write it out first and then just transfer it. Supplies on hand, $200. So my ledger account's telling me that I've got $400, but when I count it up, I have $200. So the beginning balance minus the ending balance means I must have used, oh, I'm sorry, it's not 400, it's 700. I started with 700 and now I have 200. So that means I must have used 500. So the adjustment would be a debit to supplies expense for 500 and a credit to the office supplies for 500. For B, I see depreciation expense. Oh, so let's go ahead and put those in. I debited supplies expense 500 and I credited office supplies 500, and that's for transaction A. For B here, as soon as I see depreciation, I know I'm going to debit depreciation expense 1100, and I'm going to credit accumulated depreciation 1100. So we can put that on here. depreciation expense is the debit, and accumulated depreciation is the credit. And then a last one is accrued expense. So for, let's see, I'll stick that up here. For C, accrued interest expense. As soon as I see an accrued expense, I know I debit an expense, so that'll be interest expense, $200, and I credit a liability, interest payable, $200. So if we put that guy on here, this is transaction C, a debit to interest expense for $200, and a credit to interest payable for $200. So that's all of my 3 adjusting entries, and so now it's just calculating the new balance. I didn't do anything to cash, so I just bring that $400 over. Office supplies, I started with $700, and then I credited $500, so that brings it down to $200, which matches now what I have on hand. Equipment, I didn't do anything, so I just bring that over. Accumulated depreciation, I started with $1,100 in it, I credited another $1,100, so my new credit balance is $2,200. A credit to a credit means I'm going to add them together. And then accounts payable, I didn't do anything, so just bring that over, but it's a liability, so it has a credit balance. Interest payable, I had a 0 balance, and then I credited $200, so we'll put that over here. Notes payable, another liability, so another credit balance. The capital account, I didn't touch that, so I just carry over that same credit balance. There's no withdrawals. Revenue I didn't touch that, so I just bring that same credit balance over. Rent expense, this is an expense, it has a debit balance, so it's still $4,400. And supplies had a 0, I debited at $500, so that's over here. Depreciation had 0, so I debited that, so that's $1,100. And then this last one, there was $200 in interest expense, I debited another $200, so $200 and $200, my new balance is a $400 debit balance in the expense. So I add those guys all up, and I've got, let's see, my adjustments, I've got $1,800 here and $1,800 here, so that's good. And then for my adjusted trial balance, $21,700, and I add up my credits and I get $21,700, and so these guys balance, and that's good. So this summarizes everything we've done so far, and then in the next chapter, when we close it out, we can show that on the worksheet. And the great thing about that is when you've got it all done, once you get to generating your financial statements, every one of those numbers you've seen before, so you can verify that everything is right as you're closing out the process. So that's what the worksheet looks like for now, and we'll add on to that, and that's it for chapter 3.